I'm going to riff for a minute on what I believe is the biggest risk facing investors today. Now, I'm a financial advisor, and these videos that I create are for high end professional financial advisors, particularly advisors who are forward focused planning advisors. I've dealt for 40 years in truly comprehensive financial services for affluent families. For 25 years, I ran a multifamily office. In my opinion, for decades, the biggest risk facing most individuals and families goes by different names, but I would call it the risk of loss of purchasing power. Now, financial advisors and retail clients call this risk different things. We call it inflation. We call it debasement of the dollar, dilution. It goes in several different names. But I just did some calculations that even after being in this business for as many decades as I have, it caught my attention. Pretty much knocked my socks off. We think of inflation as this annoying nuisance that we just have to deal with. We go to the grocery store, we look at the price of eggs and cheese and steak and whatnot, and we know over time prices go up. But what professional financial advisors understand that families tend not to understand as well is that what's really going on here is the dilution of the dollar, the debasement of the dollar. Professional financial advisors are often trained in this. They think about dilution in terms of maybe stock dilution. Many financial advisors are tested on this concept. You have a company that issues 1,000 shares of stock, and the stock trades for $100 a share. All the shareholders, when you add up all their 1,000 shares of stock, it's worth $100 per share. But then let's say the company decides they need to raise capital, so they issue another 1,000 shares to new shareholders. Now the company has a lot more capital that they can use to grow the company, but what's happened to the owners of the company? They've been diluted. Before, there were just 1,000 shares worth $100 each. Now there's 2,000 shares, and at least on the day of issuance of those new shares, all the existing shareholders' value per share dropped from $100 per share down to $50. So that's dilution. It's watching a phenomenon where the value of what you're holding is diluting. When it comes to currency, the same is true. Governments print money. Every year, if a government is spending more than it's bringing in taxes and other revenues, that's deficit spending. This is what drives inflation. There's a lot of confusion in the retail public. What is inflation? Is it these greedy corporations raising their prices on the little guy? There may be some of that, but that's not what's driving inflation. What's driving inflation is the printing of new dollars. It's the dilution of the dollar. The question is, to what extent? A few years ago after the pandemic, we saw inflation spike up to 8 or 9%, and it was quite a controversy in the headlines. But then supposedly things have settled down. But it's relentless, whether it's 2 or 3% or whether it's 9%. The one thing we all agree is that inflation is ratcheting up. It's persistent. Nothing ever goes down in price. Everything just goes up in price. The reason I'm going through all of this is to explain that the biggest risk to families, and I've been serving families for over 40 years. I've been an equity analyst, analyzing stocks and bonds and mutual funds since 1969, so far longer than I've been a financial advisor. I have been aware of this problem where when you're investing your money, the money has to grow faster than the debasement or the dilution of the currency. Said simply, we need to make sure our clients' money is growing faster than it's diluting. The question is, how fast is the money diluting? There have been lots of studies on this. The dilution rate of the dollar is 7% per year. In other words, they print 7% more money every year. So we have an expanding supply of money about the rate of 7%. Other countries around the world are substantially more. The average fiat currency around the world is diluting or debasing or inflating to the tune of something like 10 to 12%. So the US dollar is inflating very quickly. As a matter of fact, if you look at the current budget deficit, just to do quick math on what I'm saying, take your calculator out. If you look at the amount of money that currently exists, I'm talking about US dollars, it's measured in a publicly available number. They call it M2. M2 represents all the dollars that exist, and that number currently is 22.21 trillion US dollars. So how much is the government spending over the last 12 months over and above the revenues that they're bringing in? That number is 1.9 trillion. I want you to take your calculator and do the math. So the question becomes, you take 1.9 trillion, just take 1.9 divided by 22.21. That's 1.9 trillion of deficit is what percentage of 22.21 trillion of existing money supply? Your calculator should be showing 8.56%. So regardless of what they're saying as far as the advertised inflation rate, which we call the consumer price index, any financial advisor that's been studying this for any period of time, they understand that basket of goods, somehow the measurement always ends up to be something around 2 to 3% on average. So put that aside, just look at the dilution of the dollar. We are currently spending 8.56% more, and our government needs to print something on the order of that amount of money. So where am I going with all this? I want you as a financial advisor to really understand the impact of this. Dilution, debasement, whatever you want to call it, degradation of the US dollar over a very long period of time with some obvious spikes. We had world wars, we had pandemic, we have periods where it spikes, but then it pulls back and it evens out, the average being around 7%. So what's the impact? How does this affect a financial advisor and the risk to our affluent clients? The rule of 72 would tell us that if the money supply is growing at 7% per year, that the value of money is debasing or diluting or inflating away like a melting ice cube at the tune of about 50% every 10 years. It's actually 10.29 years. Figure 10 and a half years. So if a client says, for example, I just want financial independence, I want to put together savings and investment portfolio, and we just want to get to the point, let's say I want to work for 20 more years, and then I just want to live off my savings and my investments, and we need, let me just pick a number, $10,000 per month coming in from the portfolio at that time. As an advisor, what you're currently thinking of is $10,000 per month today is not going to be $10,000 per month 20 years from now. So what's it going to be? On the fly, you should be able to explain to a client, well, the way that the dilution of the dollar is actually working, what you think of as $10,000 today. I could go buy cars, I could buy real estate, I could go out into the grocery store and buy things with my $10,000 today, travel, fuel for the car. $10,000 today, you're going to need something more like $20,000 10 years from now and $40,000 20 years from now. What you think of as $10,000 today is going to be a moving target, assuming that the US dollar continues debasing at the rate that it has over the last 100 years. So that's the reality. Now, when I go through this with professional, high-end financial advisors, I get quite a bit of pushback. The pushback I get is twofold. One is I use 2 or 3% with my clients. I'm very comfortable with that. And there's some level of skepticism on this 7% number. But what if it's true? What if I'm saying is accurate? What if the actual value of the dollars that your clients hold are cutting in half, approximately, every 10 years? Then would it change the planning that you provide to your clients, and would it help your clients have a more accurate view of their financial future and what it's going to take to accomplish the results and the outcomes that they're sharing with you? I would say yes. So let me give you an example from my life, and I could give you many examples. For one thing, the thing that I'm constantly saying is that I paid twice as much for my last new car as I paid for my first home. And my wife and I bought a 3-bedroom home. It's where my daughter grew up, and I paid half as much for that house as I did for my last car. So that's one example of what we're talking about here. But let me tell you what knocked my socks off. I got to thinking about the fact that when I was a kid, coins in the US were made out of silver. When you pulled out a pocket full of change and you looked at the quarters and the dimes that were in your pocket, the quarters were made of silver, the dimes were made of silver. And I got to thinking about it. When did I get my first job? I got my first working job at age 15 when it was legal. So I grew up in Texas. At age 15, when it was legal, I went to work in a grocery store. I bagged groceries. I was a cashier. I was a stocker. I worked in the produce department. Mainly, I was a cashier at this grocery store. As I looked in the drawer, some of the quarters and some of the dimes were silver. Not all of them. Why was that? Because in 1965, the U.S. government passed a law saying they're going to stop making quarters and stop making dimes out of silver, which they did. Now, why did they do that? There's the advertised reason, and then there's the real reason. The advertised reason, and they made a case to the American public, we're going to start making quarters and dimes out of nickel and copper, or maybe it's bronze, I don't know, but not silver, in 1965, because the cost of the silver was more than the cost of the quarter or the dime. And so they just didn't think it made sense. And that made sense to the American public. It's funny, flash forward to today, where we've just learned in the headlines in the Wall Street Journal, I read just months ago, that the cost of coining a penny costs more than a penny. So we're back to the same problem, and it's with cheaper metals. But the point is that when I would open my cash drawer at age 15 and look inside at the quarters and dimes, it was 1972. They had stopped coining silver coins in 1965, but they never took them out of circulation. They were still out there. You just had to fish through and find them. So the minimum wage when I was 15 was $1.60 per hour. Imagine that. I'd work a whole hour and I get $1.60. Woohoo! But I worked about 20 hours a week after school. What I would do is I would take my pay, and if you think about it, $1.60 is 6 quarters and 1 dime. So $1.60, 6 quarters, 1 dime. Every time I got a paycheck, I would swap out my paycheck for silver coins. For every 6 quarters and 1 dime, I got to thinking recently, I wonder what that silver would be worth today. If I had 4 quarters and 1 dime of the silver that was in a quarter and a dime back when I was 15, what would that be worth today? Those 4 quarters and that 1 dime, just the value of the silver in those coins would be worth today $39. So what we think of today as $1.60, had we stayed on the silver standard, if we continued making coins out of that metal, if kids today made $1.60 minimum wage, but we had never changed the silver standard on the coins, they would be making $39 per hour today. And that's what kind of blew my mind. I got to thinking, I work 20 hours a week. What would that be in silver today for the equivalent of 4 quarters and 1 dime for every hour I worked 20 hours? I was making what we think of today as $780 per week. When I was 15, that worked out to $3,120 a month. This is my message to you. I want you to understand that The purchasing power of your clients' dollars is diluting, it's debasing, it's degrading, it's like a melting ice cube. And I want you to be able to explain to clients why you are projecting their plan in the way that you're doing it, that you are just looking at reality. The way the world works is, for whatever reason, the value of the US dollar is diluting at an average rate of 7% per year. Yes, sometimes higher, sometimes lower. I would say since the pandemic, we've had an average inflation rate of closer to 8 to 9%, if we're being real, just for the past 5 years. If I were to go back 20, 30 years, we're talking back to 7%. So as we're making projections going forward, I want you to be aware of the fact that this risk, in my opinion, is by far the greatest risk facing most families. And what are you paid for? If a client is paying you, they're compensating you, and in any part of your job is to help them by creating a playbook, a game plan of how to get from where they are now to where they want to be with their finances in the future. They want an overarching strategy where you explain to them, I understand what you're trying to achieve. Here's how you're going to get there. And you tell them exactly what they need to do. You need to put this amount of money aside on an annual basis or monthly basis. But my point to you is make it clear to them this risk to their purchasing power and make sure that on your end, you're adequately planning for that risk, that you're not creating a plan where the two biggest risks are the fact that they either don't reach their goal on the timeline that they've shared with you, or they go ahead and push it and they reach the goal and they feel like they're at financial independence. They start taking $40,000 a month, 20 years from now, from their portfolio. But what you've actually done, if you're not careful, is you've put a plan in motion for them to run out of money before the end of their life. So my objective is for you to be able to create an experience around an overarching plan for your clients that's extraordinary, and to create this extraordinary client experience in a way that AI cannot do. That's what we do at the Mark of Mastery. We encourage you to join us. We are entirely comprised of professional, high-end, advanced planning financial advisors who are future-focused, and we are mission-driven to not be displaced by AI and all the inflection points that are currently facing our industry, like a tidal wave coming towards us. And what is possible is to create a business where you are providing so much more value than any other advisor. I want you to dig into this issue of the dilution, the debasement of the currency, and to understand the level of risk that your clients are facing so that you can deliver an extraordinary client experience.